We tend to find that growing businesses need to raise bank debt. We find that those businesses, our typical client database will be small, medium-sized, owner-managed businesses. Those businesses, when they have a need for growth, they will typically have a need for funding, and that funding in today's market tends to come from bank debt. Some will go out and raise private equity, some will look at raising money on the public markets. We certainly find that in today's environment we're getting a lot of businesses finding that bank debt is the way forward. It can be cheaper, more accessible, it can help you buy property, plant and equipment, it can help you to acquire the premises you work in. Rather than leasing the premises, you can use it for acquisitive growth or organic growth for opening new offices, for example. So we think there's a number of reasons why businesses might be seeking bank debt, and a number of businesses that would suit the raising of bank debt in today's climate. But no, on the contrary, we're finding in today's market with historically low interest rates, bank debt is actually one of the best ways of raising finance, for whether it's for acquisition or for acquiring plant or machinery or working capital. And we're finding that because banks themselves are under some pressure to get money out of the door, the rates which they're offering are quite benign, and certainly the types of security they're looking for are perhaps lighter than they have been in the last 10 or 12 years. So certainly at the moment I wouldn't say it's an outdated way of raising money. In fact, it's a very popular way of raising money, and we're finding that the banks are in touch with us regularly looking for businesses that might want their lending. We would always find that coming and speaking to us will give you the best opportunity of putting a business plan across to a bank in a professional fashion. It doesn't cost anything to come and meet us, to have a quick discussion over what might be possible, what the lending terms might be that we can secure for you. And certainly we find that banks prefer to see business plans that are being produced by an advisor rather than directly from the company. It gives them a level of comfort which will allow them also, for their part, to look at the security they're offering and to ensure that the rates are actually as keen as they might be in this current lending environment. We would always recommend going to your own bank manager in the first instance, but we do think there's value in the competitive tension which can be created by going to a number of lenders, and that's where we can help. And we think that competitive tension will allow you to ensure that the rates you pay are the keenest they can be in the market, and the security net which you have to offer as a corporate is as competitive as it can be.